And let me start with one number, that is 40,000. And that's how many American homes bank seized in just 1 month. Not over a year, not during a recession headline, in 1 month. And what bothered me wasn't just the number, it was the silence around it. And this is not a housing crash story, this is a middle class stress story, and it's only getting started. So what actually happened? In January 2026, foreclosure activity in the US jumped again. Over 40,500 properties entered foreclosure, a 32% increase compared to the last year. That makes in the 11th straight month where foreclosures are rising year over year. 11 months, and that's a trend. And when people hear foreclosure, they usually imagine renters or people who never should have bought homes in the first place. But that's not what this data is saying. These are homeowners, people with jobs, people who passed credit checks, people who are doing everything right. And now they are losing their homes. And why this matter more than people think? So foreclosure isn't the first warning sign, it's the last one. Before a home is seized, here's what already happened. Missed payments, credit card maxed out, savings drained, lifestyle cut back. Stress carried quietly for months. In many states, it takes 6 to 12 months from the first missed payment to the bank actually taking the house, which means this January foreclosure data reflects financial stress that started last December. And this is lagging data, and lagging data is dangerous because by the time it shows up, the damage is already done, and the middle class is the one breaking. When I dug deeper into the numbers, something stood out. This isn't hitting the ultra rich, and it's not primarily hitting the poorest renters, it's hitting the lower half of the middle class. Why? Because that group has less savings, lives paycheck to paycheck, carries more variable debt, has less margin for error, and margin for error is everything. One medical bill, one insurance hike, one job disruption, that's all it takes. And this brings us to the quiet killer most people are ignoring. America is sitting near $1.3 trillion in credit card debt, and that's not discretionary spending anymore, that's the survival spending. Yes, inflation rates have come down, but prices haven't. Groceries are still expensive, insurance is still up, utilities are higher, property taxes didn't come down. So people filled the gap with debt, and debt always works until it doesn't. When minimum payments rise, something has to give, and eventually people choose food, fuel, and family over the mortgage. And that's not irresponsibility, that's maths. And where this is hitting the hardest. Now let's talk geography, because this part surprised even me. The worst foreclosure rate in the country isn't California or New York, it's Delaware, a small state with roughly 1 million people, ranking number 1 in foreclosure rates. Behind it, Nevada, Florida, South Carolina, Maryland. And when you zoom into metro areas, you see places like Trenton, New Jersey, Punta Gorda, Florida, North Carolina. These aren't speculative tech hubs, these are working class housing market. And that tells you exactly who's under pressure. This isn't 2008, and that's the point. People always ask, is this another 2008? The answer is no, and that's what makes it dangerous. In 2008, the system broke fast, bad loans, overbuilding, and leverage everywhere. This time the system is breaking slowly. Fixed rate mortgages are holding up better, banks are more capitalized, but the consumer is weaker. The middle class doesn't collapse overnight, it erodes. One missed payment at a time, one quiet foreclosure at a time, and that's harder to see and easier to ignore. And after looking at all of this, here's my honest conclusion. We are not watching a housing crash, we are watching a confidence collapse in the middle class. People didn't suddenly become bad with money, they ran out of margin. And when banks can seize 40,000 homes in a single month, that's not a warning sign, that's a message. If you own a home, know your numbers, build cash, respect risk, and if you are thinking of buying, don't rush, don't buy on narratives, buy on resilience because the data is clear. The pain isn't over, and the people feeling it most